Welcome. Thanks for joining us on this Monday's Market Call. I'm Morella Fernandez. David Driscoll with us today. He's President and CEO, Liberty International Investment Management. He's taking your questions on global and North American stocks today. So here is how to reach us. You can call us toll-free, 1-855-326-6266. You can also send an email in if you have a question. marketcall@bnnbloomberg.ca. David, thanks for coming in. New Canadian tariffs for steel and aluminum, of course, today. We did see some metal dropping. Our new normal is this now?
Well, it's the expectation that investors are going to have, and also think about what consumer prices are going to look like and how consumers may have to cut back, because 2/3 of all economic growth comes from the consumer. So if they're having to pare back on their spending, then chances are that future profitability may be weak in the coming quarters.
Okay, let's talk about where you're investing these days. Are you staying away from the American market as a result of the volatility? Are you staying in Canadian stocks? What's your approach these days?
We set a plan and stick to it. So we're about, if we had a 30 stock portfolio, you'd have about 4 Canadian, 13 US, 13 international. Because remember, Morella, it's not where the companies are domiciled, it's where the revenue streams are coming from. And I've gotten emails the last few weeks about the Canadian US dollar, et cetera. And it's important for investors to understand that currency risk becomes benign over a 10 to 20 year time horizon. So if you think of the US dollar versus Canadian dollar, the actual annual change in the last 25 years has been 0.2%. With Europe, it's been 0.6. So don't fret. The way that we think about it is we have a list of stocks, and each client's portfolios are customized. So of those 30 names that they have, we'll just look at the percent weightings in the portfolio. And when it comes time to do some buying, we'll look at the ones that are the lightest weight, because they're the ones that are obviously down the most, with the expectation that at some point in time, profits will return and stock prices will turn around and start to go up again.
So because you do the long term, do you move at all in these times of great volatility, or do you try and sail right through, or are you picking different sectors from where you've initially invested?
The way that we manage the risk, which is not amongst our peers, is to not only keep the percent weightings in line, but we also want to have at least 50% in the 4 inelastic industries of consumer, healthcare, financials, and utilities. The other 50% can go into the more volatile technology or industrials. By country, again, that 20-40-40 mix. And then by size of company, we want to have 50% in large caps, where most of the profits are being used to pay out dividends. So that's the income side of the portfolio. But we still want to have another 40 to 50% in small and mid caps. And that's because more of the profits are going back into the business for capital appreciation over time. So you get that nice blend of income and growth. So that with the dividend growth, then that offsets inflation. And we don't have to chase sectors or areas because we're already global managers. So when the emerging markets took off and Europe took off, we're already there. So we've benefited from it.
Got it. All right, we're going to take a quick break, line up some phone calls and questions for David Driscoll of Liberty International Investment Management. Your questions today on global and North American stocks. We're back in a moment. Welcome back to Market Call. Let's go straight to an email coming from Carl. He says, could Mr. Driscoll please share his views on BCE versus Telus? BCE, of course, we remind people, is the parent company of this channel under the Bell Media brand. When you compare the two, which way do you lean? It's hard for telecommunications companies, period, right now.
Yeah, well, they're pretty much the same, the large ones, the Telus, the Rogers, the BCEs of the world. But when you start to drill into the metrics, you can start to see a different story. So Telus in the last quarter increased their dividend, BCE cut theirs, which gives you a strong indication that the cash flow is very high at BCE and not so bad at Telus. Both of them are suffering from credit downgrades because with all this 5G build out, they took on debt but weren't able to increase pricing. And then of course, a drop in number of immigrants coming into the country has slowed down business as well. So just like Europe or other places in the world, there's a lot of price competition going on out there. But Telus is less risky than BCE right now. And when we always compare either debt to equity, BCE's debt to equity is at 200%, Telus is a little lower at about 150. So they don't have as much onus on debt repayment, which is the reason why BCE had to cut their dividend. And then Telus has the other two potential operations of Telus International, Telus Meta Health. So they're doing other things outside of just telecom, which appears to be promising, but again, we'll see.
Okay, so hope that helps Carl out when he's making that decision. Let's move to Elliot calling from Hamilton, Ontario today. Hi, Elliot.
Good afternoon. Against the backdrop of Allstate, Intact, Definity, all these property and casualty companies hitting continually new time highs, what is the problem with Chubb, which seems to be in a range 5 to 10% below its recent highs? Why can't Chubb get any traction? Thank you.
Thanks for the question.
Well, that's the difficult question. I mean, we do own Chubb. We've owned it for a very long time, all the way back to when it was Ace before it merged with Chubb. And right now, you're looking at property casualty combined ratios for Chubb in the 83% range. And that is amongst the lowest of all the group there. So what it means is for every dollar of policy that they're issuing, they're only paying 83 cents out in the form of claims. So that 17-cent difference is free cash flow to them, which they invest in a bond portfolio that's pretty much short to medium term, whereas most insurance companies would have a 60-40 mix of 60% equities, 40% fixed. They are very conservative. Their pricing has been very good. Because they're a larger company than some of the others, they are exposed more to all of the catastrophe risk that's out there. But they offset that about 90% by buying reinsurance for the number of policies that they write. As far as outperformance, underperformance, long-term performance for Chubb has been, give me a second here.
Are they American only?
They're out of Switzerland, actually.
And do they operate internationally then?
Oh, yeah, they're global.
Okay.
Yeah. So for Chubb, 1-year returns, 8% year to date, 10 years at 13, 15% for 15 years. That's what the target should be over time. And I certainly like the insurance companies a lot more than banks right now, only because of what may be coming with interest rates and loan refinances, both in Canada and US.
Got it. Okay, Elliot, I hope that helps you out. We're going to move on to Brian calling from Trenton, Ontario with a question. Hi, Brian.
Oh, good afternoon. I'm just calling regarding Jardine Matheson, which you referred to, I think the last time were you on. I bought some also for international exposure. What's your view still on the stock today?
Jardine Matheson.
Well, in the 3 weeks since I was last on,
Not much has changed.
price movement, no, not a lot has changed, only that the stock has fallen a little bit back because of the trade imbroglio between the US and China. Jardine Matheson is a conglomerate, big holding company throughout Southeast Asia. So about 25% of their revenues are in China through Hong Kong land, but they've also got other subsidiaries in machine leasing, hotels, restaurants, grocery stores, et cetera. Indonesia is their biggest revenue maker. And that's why we use it as a proxy for all of Southeast Asia, because they have their tentacles everywhere. What you're getting is, from an investment, 5% dividend yield that's been growing at roughly a 5 to 10% rate each year, low volatility, and then again, now that the US dollar has been falling, the emerging market stocks have really done well. And as a result, Jardine's had a big pickup of 13% year to date.
Is there any effect of a turn in the economy in China as a result of the tariffs from America and all of that export being marked up?
Well, it'll hurt their construction and real estate business, and will have an impact on the satellite nations outside of China. So if China improves, then yes, the stock should continue to grow. If it doesn't, then it could just go sideways.
Got it.
But in the meantime, you're still making 5% while you wait.
All right, let's go to Steve on the line in Toronto. Hi, Steve.
Hi. My question is on the Toronto Dominion Bank. It's had a good run over the last 6 months, and it's working through the issues that it had in the U.S. I would like to know if you would be a buyer at this level right now. Would you add more, or would you wait? Thank you very much.
Okay.
Well, I think the stock had its rally simply because of the big sell-off that went off when the first announcements of the 3 or 4 billion in
$3 billion
in fines,
which was the end of last year.
Yeah, but they're still in the penalty box in the United States. They are not allowed to grow their business there. And Wells Fargo news has been coming out that the Fed may lift the restrictions that they've been under for the last 5 years. So if they can't grow their business, then where are they going to grow overall? Because Canada, you know, the big banks have bought Canadian Western Bank. The only thing that's left would be Laurentian Bank, and it seems like nobody's interested because it's all mostly commercial mortgage businesses. So where is TD going to grow? And that's going to be the big challenge for them moving forward. And they want to get a bigger footprint into digital, which is why they've been laying off staff and putting more money towards people that can help them in the wealth management business and also in, you know, underwriting and capital markets. But this has been a big run up. I wouldn't buy the stock here because, again, with that overhang that could be lasting for a number of years, I don't see a whole lot of higher upside.
That's where they need to grow to get a bigger boost.
Is in the U.S., yeah.
Got it. Okay. We're going to take a quick break. We're going to line up some more phone calls for David Driscoll of Liberty International Investment Management. We're back in a moment. Welcome back. Let's go to the phone lines. Bob's been holding on the line from Toronto. Hi, Bob.
Yeah, hi. How are you? I hope you're doing well. Can you please tell me, David, your thoughts on Nutrien? I bought it in the low 100s. It went up to 140. It went down to 60. Now I think it's in the mid 80s. So what's your thoughts on that? Will it go higher? And do you have a price target?
Okay, let's talk about Nutrien, which has had a lot of, I guess, hills and valleys. There was initially, I guess, a potash tariff at one point as well. So,
yeah, and then that eased. The news coming out of the company lately is they're seeking a new West Coast terminal to export more potash. Prices are just starting to trend a little bit higher, so demand is starting to pick up. And supply, which had been muted, has actually been going down. So I don't offer price targets because there's no point, especially with a volatile stock like this. What you're getting is a 3% dividend yield. You're getting part of the Canpotex cartel, which is in the business of exporting fertilizer worldwide. If we're going to have warmer temperatures and the growing seasons are going to be more difficult, then obviously demand for fertilizer should start to continue to rise because foodstuff demand is going to be there. So you have to think of the long-term picture, but also understand short-term, everything's going to be volatile when you're dealing with resource companies and commodity prices.
So you have to be able to sort of stick it through.
Yep, it's a long-term investment. Long-term returns have been Nutrien 27% year to date. It's had the big rally. 5-year 15%, but the 10-year has been in the 6, 15-year in the 10% range. So somewhere in that 5 to 10% range should be total return over time expectation.
Got it. Okay, let's go back to the phone lines. Alfred's on the line. He's calling from Mountain View. Alfred, what's your question?
Yeah, hi, thank you. My question is about Berkshire Hathaway Class B shares. Recently, the stock seems to be lagging the rest of the indices. Your medium and long-term view on the stock, and I take my answer. Thank you so much.
Okay, thank you for the question. Berkshire Hathaway, do you own Berkshire?
No.
Okay.
And the reason is what's going to happen if and when Warren decides to either die or...
Well, he's going to retire by the end of the year, right?
Yeah. So everybody's sitting on the 300 billion odd of cash, of which some of that is going to have to be used towards the company buying back his shares when he does depart this world. The difficulty with Berkshire is it's a huge conglomerate that to move the needle on earnings or price, they have to make bigger and bigger acquisitions which they're not finding right now. The only thing that I've noticed that they're actively buying is still more Occidental Petroleum and more of the Japanese banks.
Okay.
From that standpoint, they have gone into other areas, and I imagine that's the lieutenants that are doing these purchases. And, you know, they're just becoming a bigger conglomerate, and returns are probably going to start to be more like insurance returns over time, because that's the biggest portion of the business. But they've also got railways and electric utilities, et cetera. So it's just a matter of, don't worry about the volatility in the stock price in the short term. You have to be focused on the long run and what are you going to get over time, which is probably around a 10% compound annual return.
Okay, so there's basically not a lot of huge growth expected. It'll grow, but it's not going to make leaps and bounds.
Yeah, that's the expectation.
Got it. Okay, Alfred, I hope that helps you out as we move on to Jeff, who's calling from Edmonton with a question. Hi, Jeff.
Good morning, Morel. Thanks for taking my call. I'm wondering if Dave could shed some light on Stantec. It seems to be going crazy in the last couple of weeks here. I just don't know what's going on with it. Thank you.
Thanks for the question.
Well, they had a banner earnings results that came out. Revenues are growing faster than analysts had expected. They're into environmental, architectural, especially in Canada, the United States. This is a stock that we've owned for the better part of 10 years. I think our first purchase was around the $25 range, and now here we are in the stratosphere. So it's done very well for us. It's up 25% year to date. Long-term averages, because companies don't grow linearly forever, would be about a 15% compound annual return based on the business and the demand that's going on, because they just tend to be in the right spot at the right time right now.
And you like them moving forward?
Yep.
Got it. Okay, engineering architecture company. Jeff, hope that helps you with your question. Ben is calling on the line from Kingston, Ontario today. Hi, Ben.
Hi, thank you for taking my call. My question is on Apple, particularly its outlook as we look forward. It's been consolidating around $200 or 201 for a little bit now. And second question is about the Apple suppliers, especially the electronic supplier out of Taiwan, the Foxconn. I'm really concerned as to what happens when they move to India, or they have moved to India. Now there's a pressure to move back to North America. So I would like your outlook on that with a price target, please. Thank you.
Thanks for the question. So a lot of analysts are talking about the fact that they can't move to North America. They're too ingrained in China to be able to easily move.
So it's supply chains and it's labor costs at the same time. So China to India, they're still going to have the same issues. They're not going to appease the president because he wants them to start building in the U.S. But again, their argument is we can't do this right now. And if we did it, it's going to take years, not months.
And cost a lot more money for a phone.
Correct.
Yeah.
So people were, I think, there were targets around $3,000 to a phone, as opposed to what people are paying for now.
Half of that, essentially, yeah.
The other problem that Apple has is, of course, they are more like a consumer stock, where they haven't really been introducing anything new into the market. And yes, they make money on maintenance and service, but at the same time, it's starting to ebb. So margins are beginning to decline. The stock, which was a high in last December at 260, has fallen 30% to 200. It's not the one of the Magnificent Seven that's in favor right now. And I don't give price targets, so please don't ask.
Okay. So a lot of things to watch for Apple, generally speaking, as they work their way through the demands to be back in North America, as well as ongoing
definitely, because, I mean, what are you going to do? Wait out 4 years? Or?
Yeah. And we're only in 6 months, so
exactly.
There's a way to go.
Yep.
Ben, I hope that gives you some answers you're looking for. We're going to take a quick break. We're going to take a look at David's past picks when we come back. Time now for a look at David's past picks. These are from July 2nd, 2024. His first one at the time was Carl Zeiss Meditech. So this is out of Germany, trading there. Let's talk about Carl Zeiss Meditech. What do they make?
Well, lenses. So it's basically ophthalmology and lenses for surgeons doing operations.
Got it.
The stock is up 20% off its bottom because their earnings have met expectations, but growth is still going to be reserved just because of sales to China, which are starting to turn around a little bit, but again, not to the expectations of analysts or the street. So this is one where you can dollar cost average because it was as high as $150 a share, and now it's down into the 54 euro range. So again, if you think of what sectors have not performed this year, healthcare is the big one. Again, because of what's going on in the United States with cutting back on scientific spending.
Research money.
All that research money. You've got changes at the FDA. Again, even for a company like Becton Dickinson with syringes, that if they're going to be anti-vaxxers, then all of the need for needles starts to ease off. Carl Zeiss does depend on ophthalmology on one side, but the big maker is providing the lenses for surgeries in hospitals. So hospitals don't have the expenditures to continue to buy the equipment. They don't imagine that we're not going to see $150 or 150 euros anytime soon. And it will probably just flatline here until they start to get some traction out of China and the stock to start to pick up again. Small caps around the world are suffering, especially in the United States, because that's the one index that's down the most, about 8% so far year to date. Again, tariffs, fear of inflation, higher interest rates. Tech stocks and small caps do poorly if rates start to rise because of higher inflation, and this is what we're going to get when we talk about all three of them, because they're all small caps.
Got it. Okay, let's get to your next pick, which is Enghouse Systems, which is an engineering consultation company. So they're on the TSX. At the time, you recommended it. It was $30.56. And now it's to $26.45, 13% downside return, 10% total return drop.
Yep.
How big of a company is Enghouse?
They're small cap. They're only $1.4 billion in market cap, so they're really tiny. But what I like about them is a number of things. Is where they are located right now with their software is in a bit of a wheelhouse right now. Their earnings are coming out June the 5th, so we're 3 days away from seeing what the next ramp up is going to be. Usually when a company raises its dividend by 18%, the expectations are that profits are going to go up that much. I can't speculate from here, but this is a company that hit a low of 22 back in April, has been climbing back up since then, and we'll see moving forward. In the meantime, investors are getting a 4.5% dividend yield. We have it in our tax-free savings accounts, our ESPs, and all I'm doing is accumulating more over time.
You expect it to grow?
Yep.
Or be taken over?
Well, I never think of a takeover.
Okay.
However, usually when we do invest in small caps, a lot of them do end up being taken out. It could be attractive. I don't even think of it that way. I'm just thinking of the operating business right now. Margins are good and getting better. Revenues are starting to grow again too since COVID. And the outlook based on the latest two acquisitions where the Presto cards in Toronto go on a streetcar or a subway, tap, they're the ones that are running the software for all of that. Two companies out of Europe that they've acquired.
Got it. Okay, let's go to your third pick from last July, Spectris PLC. Let's have a look at where it was at the time you recommended it. It was 2,820 in pounds, I guess we have it here, and now it's down to 2014. So it's a 29% drop and then a 26 total return drop. Tell me a little bit about them.
Well, they make instrumentation, basically instruments for environmental flying controls, gas analysts, temperature measurement, etc. Demand has pretty much slowed down, and that's been the cause for the drop in price. It was as high as £33, went as low as 18, is sitting around 20 right now. Dividend yields at 4%, which again, for another small cap, with the dividend growing at roughly 7 to 10% a year, is very attractive at these levels. It's just a matter of waiting for things to turn around. And for them, they are serial acquirers, so they'll continue to make acquisitions and sit back, and when the profits recover, so should the share price.
Got it. Okay, we're going to take a quick break. David Driscoll sticking around to take your questions today on both global and North American stocks. We're back in a moment. Welcome back to Market Call. Let's go to Dave. He's on the line from St. Catharines in Ontario. Hi, Dave.
Oh, hi. I'd like to thank you for taking my call. David, I was wondering about Royal Bank and where you see that going in the next year or so. I realize they say it's the best bank in Canada, and I was just wondering, was that true? Thank you. Take care. Bye-bye.
Thanks for the question. So Royal Bank at 174. They missed a little bit on estimates last week.
Yes, costs were a little higher, loan loss provisions were a little higher than expected. Why I favor insurance companies over the banks right now is what's going to happen when all those people who bought houses in 2020 and got 5-year fixed at 1.5, where they put 20% down. If the value of the home has dropped 20%, suddenly they have no equity in the house. They suddenly become high-risk lender or mortgagees, yeah. And this is the problem that hasn't come yet to face the Canadian banks right now, is that if people are having to allocate more of their take-home pay already towards debt repayment and then see that their mortgages double or triple in payment size, what are the loan loss provisions going to look like then? And what will that impact have on profitability? So most of the banks, I think except one, did raise their loan loss provisions, but not to the degree that I expect.
Oh, you think it'll be worse than they are even planning for?
Because the Bank of Canada right now has to decide if they're going to continue to cut rates, which is fine. If they don't, however, you're looking at a 5-year Government of Canada rate currently at 2.8%, and that's where mortgage rates are used from. But if these people are being seen as higher risk mortgagees, then they're not going to be paying 2.8 for a 5-year fix. They're going to be looking closer to 5% or greater. That will slow the economy hugely and cause the Bank of Canada a lot of suffering to do, because they may have to keep cutting rates just to keep the economy going. And that's my biggest concern for the banks. As far as a long-term outlook for Royal Bank, the banks usually in that 7 to 10% long-term return version or expectations. In Royal Bank's case, 10 years, 13%, 15, 20 years, 12%. That's the expectation of owning any one of the Canadian banks. We own Royal. We sold TD last summer amongst the kerfuffle going on with the compliance issues. And we wanted Royal because of capital markets for wealth management, et cetera. The acquisition of HSBC has turned out well for them. So dividends are growing, but not to a huge degree amongst all the banks. So I much favor the insurance companies right now than I do the Canadian banks. Royal Bank we own, we don't touch the other ones.
Got it. Let's go to an email. Stuart has written in. He says, I've owned a half position of Coloplast for a few years and see the stock has struggled in the last month more than other healthcare stocks. I'm wondering if I should add to my position on the weakness. Coloplast, of course, makes medical gear. And let's take a look at their stock and see where they're at right now. Is this a company you know?
Yeah, we've owned it for the better part of 15 years, probably. So the returns for, going back 10 or 15 years have been excellent. It's just now that they're coming up with issues of tariffs, FDA approvals, manufacturing in the United States. The revenues are still growing at 6%, which is well above average. And then there's the biggest fear, which is what is AI going to have on the healthcare sector moving forward? Is there going to be some fantastic pill that will clean up people's stomachs?
Without medical intervention beyond,
Correct.
Yes.
Yeah, which Coloplast would be at risk to because they provide colostomy bags or catheters, et cetera, like that. The flip side is that you've got the long-term aging population throughout the world, which is still keeping up their revenues. But this is something that's going on in the entire healthcare sector for the most part, that the pension funds, the large institutions have shied away from healthcare in general right now and are chasing after the big movers of utilities, insurance, et cetera. With Coloplast, you're getting a 3.5% dividend yield. I don't think things are as bad as it is made out to be. And again, we look at the portfolios. The percentage average is 3.3 and it's at 2.5. we're going to dollar cost average and buy more.
Got it. Okay. Let's move on to Alexander calling from Toronto. Hi, Alexander.
Good afternoon, and thank you for taking my call. David, I'm interested in your opinion on TFI Group. Would you be buying, adding, or holding at this level? Thank you.
Okay, so TFI has struggled more recently, and some of that wasn't a surprise because of the traffic going back and forth across the border. People are like,
Correct.
It's going to go to a stop.
Yeah, tariffs, supply chains, et cetera, and deliveries. So that caused the stock to essentially, it's down 40% year to date. Again, short term, headwinds, long term, who knows? Are things going to ease up over time, or are things going to get worse? And as the caller suggested, is it a good time to be buying a quality name? The answer is yes. So when you have a thesis in play of a stock that you like, where the metrics all hit home, where the company's amongst the best in their industry, they're doing well, return on invested capital is at 10%, their weighted average cost is around 8%, so they're still making free cash flow. What's going to happen in the short term? What can companies like do during that those headwinds? Well, companies that are serial acquirers that generate free cash flow can convert their profits into cash, can use that to get them through the tough times and continue to do business as usual. Margins are going to be hurt in the short term, but in the long run, as a CEO, you still have to be thinking long term.
All of the damage that has been done to this stock since the start of the year, because they were at, what, 200, I'm looking at 217 at the start of the year, end of last year, and it's gone down, we saw it to about 115, 116. That's all tariff-induced?
Yeah.
Wow. Okay.
Yeah, because the earnings expectations are December 2025, 485 a share, which is down from the 575 last year. But 2026 expectations for earnings to get back to $6.50. That's US. So you're looking at roughly 15 times earnings.
And they pay a dividend?
I believe they do.
Okay.
Yep. Yeah. So the dividend went up from 40 to 45 cents a share, quarterly US.
Got it. Okay, we're going to take a quick break, line up some more phone calls for David Driscoll. He's with Liberty International Investment Management, and he's taking your questions on global and North American stocks. We're back in a moment. Welcome back. We're going to an email now from Dana. She says, can you ask David what he thinks of United Health after the recent pullback for a long-term hold? Is all the bad news behind the stock? You never can tell. It is about half price at this point.
Yes, because all through the first quarter, they were talking about how life was great. And then they came out 2 months later, Medicare patients' costs were going through the roof. And as a result, the previous CEO announced disappointing profits on April 17th. Company withdrew financial guidance, which of course will scare Wall Street to death, saying costs were accelerating, and then out he went. So the other issue is, how could things have fallen apart so quickly? As the Wall Street Journal article came out saying that aggressive business practices left the company vulnerable to regulatory change and scrutiny, and changes at Medicaid and Medicare may be coming, which could leave the HMO companies struggling with lower revenues and higher costs. So as a result, the stock took a dive, and the previous CEO is back in
Try to clean it up.
Yeah, to try to clean it up. I don't think it's a stock that's going to rebound anytime soon because of what's coming down the pipe with
the cuts to Medicare in the
their
U.S., the big beautiful bill, yes.
tax bill.
Okay, so there could be, there's another headwind that could hit them. Like I said, they're already 50% down from where they were, so you see...
Probably go sideways here. Yeah.
Got it. All right, let's get to another email. This is from Rob. He said, what are David's thoughts on Fairfax Financial? Fairfax, pricey stock?
Yep. Oh, well, this goes back all the way to year 2000 when the stock was around $57 a share. Everybody was shorting it. A lot of the acquisitions that Prem Watsa had made were high-cost, low-return businesses, but here we are 20 years later, and everything has evolved to the degree that it's one of the most favored stocks on the TSX, up 13% this year. We own it in our tax-free savings accounts. Chubb we own in the non-TFSAs. Again, acquisitions globally have helped them. Again, they're back in 2000, their combined ratios were well over 100%. So they were paying more in claims than they were taking in premiums. That number is down to around 94%. So underwriting performance has improved. Costs have been kept in line, and almost every operation that Fairfax has is showing profitability. And as a result, we get the big kick in returns. Estimated PE for this year is about 10 times earnings, which is normal for the insurance industry. So it's hit a high, but it's a company that we want to own for the long run. So we'll continue to buy for clients.
Got it. Let's go to one more email here from Margaret. She says, may I please have your best opinion of Smith and Nephew?
Okay, Smith & Nephew is in wound care management, hips, knees, endoscopy, orthopedics, all of that wonderful stuff. They have not performed all that great in the last while, and that's competition and the fact that they also took their eyes off the ball. So performance-wise, they're kind of like trying to think of, there are other companies, healthcare companies that haven't been as good as a company like Stryker, which is also hips and knees, Steris, which is sterilization in hospital rooms, which have done actually quite well. Smith & Nephew long-term returns have not been all that great. And if we compare them against the others, just give me a second here.
So would you go to another stock if you were thinking of investing in this side of healthcare?
Well, we own Stryker in our portfolios. And just to give you an idea, Stryker's performance the last 5 years has been plus 15% compound annual, and Smith & Nephew has been -4.
-4.
Yeah.
Okay.
So it's only this year that they're starting to pick up. But on a competitive basis, it comes down to the quality of what you're offering, as well as the ability to run the business and create returns on invested capital that are greater than the cost of capital. Stryker has done that, Smith & Nephew has not.
Got it. Okay, we're going to take a quick break, and that is all the time we have for your phone calls. But David's going to share new top picks when we come back. Thanks for joining us. David Driscoll is here with us today. We're going to take a look at his new top picks. He starts with Toromont Industries on the TSX. They do a rental of some equipment as well as some other things. Why do you like this company?
They're the Caterpillar dealership from Manitoba East. And I thought after all these acquisitions made that things might slow down, but then they go and make 2 more acquisitions in southwestern Ontario. 2 things. Number one, it's been a long-term, wonderful company. It has very little debt. It sells, rents, and leases the equipment. So even if there's a downturn in equipment sales, they still have servicing to go on, because
Got it. Okay. So
those that are making apartment buildings or digging mines abuse the equipment hugely.
Sure.
So
and it's difficult on that equipment, of course. It's not.
It's very hard on them. Yeah. Dividend increases of roughly 10% a year. The 3 top picks today are based on currently return on invested capital versus weighted average cost of capital. Because if interest rates and inflation go up, then things are going to get tighter. But this company can still generate a difference in ROIC versus WACC. So it's at 12 versus 9 right now. Dividends growing at 10% a year. The yield's at 1.75%. Even if urban building construction starts to slow down, things are picking up in the resource area because gold prices have gone up. So the gold miners are demanding equipment in a big way right now. This just gives you a lot less volatility in a stock that can grow slowly over time. Stock was at a much higher high than it is right now. So it's come down a little bit, and it's a decent time to buy right now.
Got it. And just reminding people, you like return on investment capital as a key metric.
Yes, that's how you quantify management's ability. What kind of returns can you make on the invested capital? If it's in the 15% or greater range, then you've got a company that's doing its job.
Got it. Okay, let's get to your new top pick, which is Unilever, which makes the essentials, I guess, soap and
Yes.
other things you need in your house.
If we get a slowdown globally because of all these tariffs and higher costs in supply chains, consumer discretionary will struggle. So think of companies like Moet Hennessy selling champagne, compared to Unilever, which is basically going to be healthcare, personal care products, detergent. They want to spin off their lower margin businesses such as Ben & Jerry's ice cream. And
what else do they own?
They got rid of Lipton tea, but they've got Knorr foodstuffs, Hellmann's mayonnaise, etc. So where they have the higher margins is where their focus wants to be, and they are much more globally intertwined than Procter & Gamble or others. So 60% of Unilever's revenues are outside of North America. So they've got the global reach to be able to cut the costs, improve margins, and have better returns for shareholders. So it's been struggling the last few years, but over time you're still getting a 10% return on a company that has very little risk attached to it. Because as I said before, with the four economic areas where you have less volatility, consumer, financials, healthcare, and utilities, people still have to buy their deodorant or whatever every day.
Got it. Okay, let's go to your last pick in this little bunch, Microsoft, of course, on the NASDAQ. And I'm wondering why you like Microsoft out of the tech stock.
It's one of the Magnificent Seven that we do own. What we like about it is their stickiness to both personal and corporate clients. Once you get into the Microsoft network, it's very hard to get out. Cloud computing, cloud business has improved significantly. That's why they and Meta have the two positive returns of the Mag 7 this year compared to the others. And moving forward, if quantum computing ever comes to the forefront, replacing AI chips, Microsoft is there to be able to, with the computing power. So they're totally involved in it. In the meantime, return on invested capital is at 23% versus weighted average cost of 9%, which is similar for many of the tech companies, but it gives them lots of cash flow to be able to continue to pour money into the next greatest thing.
Is there a competitor to Microsoft for the office? A lot of us have Microsoft at the office and rely on all of their apps. Who competes with them that way?
Hard to say, because it's just,
so it's
they're the dominant
Yeah.
gorilla in the room. I mean, you think of Google versus Meta on ad spending, or Apple versus Google on phones or phone systems, but Microsoft pretty much stands alone.
Okay. And when you mention the tech stocks and you only sort of, or your preference is for Microsoft, is there a second for you?
Well, we own about 15 to 20% of our portfolios, maybe tech, but they're diversified. They're not just in artificial intelligence. They can be in logistics, they can be in 5G semiconductor chips, they can be in logistics chips for the automotive industry. So what we want to do is just diversify amongst, not just crowd into the big seven. Because don't forget, if interest rates go up, what happened in 2022 was Apple was down 25 and Meta was down 70. So
70.
Yeah. So staying in the game is important. Not the upside, but how much you protect the downside, because protecting your losses is much more important than how much you make.
Your offshoots for technology, meaning you only have one in the top seven. You mentioned a couple, but how do you determine which ones you're going to pick? Is it again return on investment capital?
Yep, it's always the same metrics, and they're usually leaders or number one, number two in R&D development as well, because that's important given how fast everything is changing these days too.
Got it. Okay, we are going to leave it there. We have David Driscoll to thank for coming in today. David, thank you, appreciate that. And we're going to have a quick look at the markets before we head out. There they are. Thanks for joining us today on Market Call, and we'll see you again tomorrow.